Let's talk about transitioning from C corporation to partnership. What are the tax implications here? Here's an overview I want you to pay attention to. So the thing here is that when we talk about partnership and C corporations, you have two types of entity classifications, right? And the thing is that you have to really understand three things. First of all, your state of incorporation. You have to understand also your current tax filing status. And the third thing is you have to understand the configuration of your C corporation. Let me just explain this. So first of all, the state of incorporation. So basically, there are rules in the state where you incorporated in the first place. This could be Delaware, this could be New York, this can be Illinois, whatever. So you want to make sure that whenever you are thinking about transitioning from C corporation to partnership, that you are in compliance with those state rules. The second thing is, what is your current tax situation? So you are a C corporation, but do you file as a C corporation or you file as an S corporation? So if you are a C corporation, you probably file a form 1120. But if you file as an S corporation, if you elected to be taxed as an S corporation, then you are filing form 1120S. So you also want to pay attention to what kind of situation you currently have in terms of filing. And the third thing is the shareholders. So basically, if you want to become a partnership, you need to understand that you have to ask yourself, do you want to become a limited liability partnership or a limited partnership? In other words, you want to become an LP, an LLP, or just a regular partnership? Those are three things you need to really pay attention, because otherwise you actually will have things messed up. Remember, while a partnership is treated as an entity separate from its owners for some tax purposes, it is not treated as a separate tax-paying entity. The partnership's items of income, gain, loss, deduction, and credit are passed through to its owners and included on their income tax returns for the year that includes or ends with the end of the partnership's taxable year. For a corporation, entities classified as corporations that do not elect to be taxed as corporation are considered C corporations. The term C corporation refers to subchapter C of the Internal Revenue Code, which governs the taxation of a C corporation. So under subchapter C of the code, a corporation is treated as a separate taxable entity, and the income generated by the corporate business is taxed twice. Double taxation. Very important. And one thing I want to say here is that when we talk about there are federal federal income tax treatment of classification changes. And this is really, really important to really pay attention to that. Now, what I want to say here is that there is a form called 8832. So that's the form that allows you to actually change your classification. And I'm showing you right now this form on the screen. So basically what will happen here is that there are three ways to accomplish a classification change. So first of all, you have an elective classification change by filing form 8832 on the screen right now. You also have an automatic classification change wherein an entity's default classification changes as a result of a change in the number of owners, and an actual conversion wherein an entity merges into or liquidates and forms an entity that has the desired classification. So if a corporation, for instance, elects to be classified as a partnership, the corporation will be deemed to have distributed all of its assets and liabilities to its shareholders in liquidation, and the shareholders are deemed to continue contributing all the distributed assets and liabilities immediately thereafter to a newly formed partnership. And the entity will therefore be deemed to have liquidated under either Section 331 or Section 332, and the deemed liquidation is treated for tax purposes as if it were an actual liquidation. So this is kind of important to remember. And an entity that is not regarded as an eligible entity will first need to convert into an eligible entity before making the check the box election. So lastly, an actual conversion can be implemented. So if a corporation merges into a partnership, the IRS will alter the transaction as a transfer of assets by the corporation to the partnership in exchange for partnership interest. And this will then be followed by the distribution of the partnership interest by the corporation to its shareholders in complete liquidation. And what happens here is that the transfer of assets to the partnership will generally be tax-free under Section 721, not 521, 721, and the liquidation is tax-free under Section 332. If it meets, of course, the requirements of that section. Otherwise, it is taxable under Section 331. By the way, boss, I want to welcome you back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Let me give you a few pro tips here. So when we talk about C corporation to partnership conversion, there are some tax issues and there are some factors to consider before converting your C corporation to a partnership. Okay. And the thing is that, so first of all, C corporation's earnings are their earnings are double taxed, right? We all know that this is the double taxation. So you actually pay taxes on Form 1120, and you also pay taxes when the shareholders are paying or filing their Schedule C of Form 1040. So that's number one. Number two, basically, whether you have S corporation or partnerships, those are generally exempt from taxes, but shareholders are not. So basically, what happens here is that a partnership or an S corporation is a pass-through entity. So while it files an informational return, Form 1120S or Form 1065, it doesn't pay income taxes at the corporate level, with a few exceptions, of course. But that doesn't mean that taxes will not be paid on profits, of course. I mean, rather, profits and or losses are passed through to the business owners or shareholders who pay individual taxes. Again, that's what I just told you earlier. You have Schedule C, Form 1040. And the third thing I want you to pay attention to here is that built-in gains. In other words, the built-in gains tax may be owed after C corporation to S corporation / partnership conversion. So one significant potential federal tax consequence is the big tax. And if an S corporation or a partnership, for that matter, inherits assets after conversion from a C corporation and sells those assets within 5 years, it will be subject to built-in gains tax on the asset sale, in addition to taxes paid by shareholders on any income they would receive through dividends. Again, so here we still have the double taxation sort of process, because what happens here is that the corporation there will be some kind of taxes paid, but also when the shareholders are filing their respective tax returns at year end, they still will be liable for taxes. Boss, I want to quickly remind you of today's topic. We are having a conversation about how to transition from C corporation to partnership. What are the tax implications you need to be aware of? Another thing I want you to remember here is that conversions have a 5-year recognition period. I think I spoke about that earlier. So if a business owner converts from a C corporation to a partnership or an S corporation, and the company waits 5 years to sell appreciated assets, big tax can be avoided. Instead, gains passed through to shareholders are taxed at the individual shareholder level. When an S corporation is terminated or a partnership is terminated and becomes a C corporation, basically the company won't have the option to elect partnership or S corporation status again for a 5-year period. And one thing I also want to say is that a partnerships or S corporation inherited passive income can be subject to tax. So after conversion from a C corporation, a partnership or a S corporation can inherit income such as rent, interest, retained earnings, funds derived from stock sales, etc., and passive income that makes up more than 25% of an S corporation's gross income is subject to tax, that's for sure. And S corporations with more than 25% of their gross income as passive income for 3 consecutive tax years may have their S corporation or partnership status terminated. Okay, and so another thing I want you to really remember here is that a partnership's inherited operating losses cannot be passed through to shareholders or partners. So unlike normal operating losses, which can be passed through to S corporation owners for deduction, inherited losses for the previous C Corp cannot be carried forward and passed through. If there are net operating loss carry forwards, they cannot be used by the S corporation or partnership. It really depends, but no, generally they cannot. A C corporation may file amended carryback returns during the 5-year recognition period. So basically, the 1120 that the C Corporation will file within the 5-year period will be amended. So those will be amended 1120 that actually have the carryback sort of posture to it. One thing I also need to tell you is that partnerships, or S corporations for that matter, cannot use the last in first out inventory valuation method. So the process of LIFO recapture, described in section 1363D, prevents S corporations and partnerships from avoiding the big tax by using the LIFO method of inventory valuation. And so at conversion, the difference between inventory value under LIFO valuation and lower of cost or market LCM valuation is generally included in the C Corp's final tax return. And the tax attributed to a LIFO recapture is actually payable in 4 installments, 4 quarterly equal installments. And another thing I need to tell you here is that not all C corporations can become partnerships or S corporations, and there are restrictions on S corporation stock and even in certain forms of partnership. So C corporations with more than 100 shareholders are not eligible for a conversion to an S corporation, and neither are corporations that issue more than one class of shares. And certain types of financial institutions and insurance companies are definitely not eligible for S corporation status, and neither are domestic international sales corporations, the DISCs or former DISCs. And certain types of shareholders are ineligible for S corporation stock ownership, and this includes foreign shareholders and certain trusts. But if you are really switching to a partnership, those restrictions actually go away. And also, one thing I want to say here is that a business owner selling to an ESOP should consider the differences between C corporation, partnership, and S corporation. So that the owner of a closely held business who has decided to sell to an ESOP as a part of a succession plan and exit strategy can expect some significant differences between selling as an S corporation, selling as a partnership, and selling as a C corporation. A C corporation owner may be able to defer and possibly avoid capital gains tax on the sale by meeting several specific requirements. And so under section 409P, ESOP-owned S corporations or partnerships are subject to anti-abuse laws, and ESOP-owned C corporations are not subject to those provisions. So the bottom line here is you want to weigh the pros and cons before conversions, because any change to a business tax status can have unintended consequences, both positive and negative, and it's a smart business practice to actually consult with a tax professional before making the election. No single choice is right for every organization. By the way, boss, I want to quickly remind you of today's topic. We're having a conversation about going from C corporation to partnership. What are the tax implications? I want to go a little granular here. So what is the approach I want you to pay attention to? So basically, let's talk about the difference between partnership and corporation at a deeper level, so we really understand exactly what we're talking about. So what is a partnership? So a partnership is a business with 2 or more owners who each contribute money, property, labor, or skills to the operation. And so the IRS considers a partnership a pass-through business, meaning all business share the profits and losses of the business and add their portion to their personal income. Partners must actually pay personal income taxes on their share of the business. Partners may also be responsible for self-employment taxes and estimated taxes, while the business itself may owe unemployment taxes and industry-specific excise taxes. And so there are 3 types of partnerships that allow you to adjust the amount of liability for business owners. Let's quickly go through those so we have a clear idea what we're speaking about. So we have general partnership, we have limited partnership, and we have limited liability partnership, so ALP. So when we talk about general partnership, when you establish a partnership, you're likely forming a general partnership, which occurs when 2 people work together to earn a profit. You may not have to officially file with a government agency when you form a general partnership, depending on the state in which you live. So a general partnership does not provide any personal liability protection. You and your partner will bear the responsibility for the business's debts, and your personal assets will be at risk if the business were sued. It is what it is. So although a general partnership doesn't offer legal protection, it requires less paperwork and simpler tax filing than other entities. it may be a great structure for a small business just starting out. So it's one of those things where you have to really think about like the opportunities there, but you do not want to take too much risk either. So let's talk about limited partnership. So a limited partnership offers some protection for partners. While one general partner must assume personal liability, the other partners, called limited partners, will be protected from personal liability. So limited partnerships must be formed through a state government agency. So this structure will be best for a business with one partner who is active in daily operations and could take on liability, as well as one or more less active partners who contribute to the business but would not want to be fully liable. And limited partners cannot be involved in day-to-day business functions. And then you have the LP, so the limited liability partnership. So this basically provides liability protection for all partners. Although regulation of LPs varies at the state level, the structure allows all partners to shield their personal assets, and partners who also would not be responsible for the actions of other partners within the business. Now let's talk about a corporation, okay? So when we talk about a C corporation, there is another type of corporation. This is not just C, you have an S corporation. So a corporation is a legal entity that's separate from its owners, and a corporation can act independently and make a profit, be taxed, and be held legally liable. And this business structure offers business owners full protection from personal liability. And a corporation is held to a higher standard of record keeping than other business entities. Corporation owners must file annual reports, hold annual shareholder meetings, elect a board of directors to oversee the business, and follow company bylaws. So because of this extra responsibilities, a corporation can be an expensive business to run. And there are several types of corporations from which you can choose from, but the two common options are C corporations and S corporations. So let's quickly talk about them. So C corporation, this is a group of business owners called shareholders. They must file articles of incorporation with the Secretary of State office to form a C Corp. And shareholders have limited liability and are not responsible for the company's debt. They can also sell shares of company stock. If you plan to take your company public, it must be classified as a C Corp. There is no limit to how many shareholders a C Corp can have. If an owner decides to leave the company or sell their shares, the company will most likely be unaffected and can continue operating. The IRS requires C Corps to pay corporate tax, and a C Corp is subject to double taxation because the company has to pay corporate taxes, while shareholders must pay taxes on the dividends they receive on their personal tax returns. And also, S corporation is totally different. Here you have a pass-through entity like a partnership and does not pay corporate taxes. So the company's profits and losses are passed through to shareholders, individual income taxes, and their portion is taxed at the personal income tax rate. And some states impose a second tax on S corporations, so you may not be able to completely avoid double taxation. Okay, so there are the differences between a partnership and corporation. You have varying degrees of personal separation from the business. Corporations owe corporate taxes, and basically partnerships require two or more owners. This is kind of important to really think about. Let me close to this conversation by giving you the steps you need to think about when it comes to choosing the right business structure. So whether you want to think about choosing C corporation or partnership, you really need to understand what is your goal. When deciding between a partnership and a corporate structure, consider the level of personal liability with which you are comfortable. So whichever business entity you choose, you may want to work with a business advisor, an attorney, or an accountant to make sure your paperwork is in order and that you are making the right choice for your small business. And one of the biggest differences between the two structures is the amount of legal protection that's provided. A corporation would offer the highest level of protection, as all owners would have limited liability. In a partnership, at least one owner would typically have unlimited liability, but you would obtain full protection if you set up a limited partnership. And your goals and plans for the business should also impact the entity you choose. So if you hope to one day take the company public, you should establish your business as a C corporation. And a C corporation is the only type of business that can raise funds through the sale of stock in the company. Okay, it's one of those things you have to think. You have to think deep, and you can change your business structure later. That's for sure. It is possible to change your business structure later. If you're just getting started and want to test your concept, consider first establishing a partnership before choosing a more formal entity like a corporation. A partnership is less complex than other structures. And the bottom line here is that you have to ask yourself again, in the states you're in, is it really profitable? Not profitable. Is it really easy to do the switch? Because otherwise, the last thing you want is to have actually nightmare after nightmare, because you're trying to really go from a quote unquote a simple structure, which is like a partnership, for instance, to go to a C Corp, which is more convoluted. Thank you so much for your attention, boss. I really appreciate it. Let me quickly do a recap here. So I was just talking to you about how to transition from C corporation to partnership and what are the things you need to really pay attention to. So I gave you the overview, the pro tips, the approach, and the steps. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.